Welcome to the Established Podcast, conversations with founders, investors, and changemakers shaping the future. Each episode uncovers the stories and lessons driving today's innovation economy. Powered by Established, we spark innovation and build connections that matter through strategy, storytelling, events, community building, investment programs, and more. Now, let's dive in.
Hello, welcome back to the Established Podcast. I'm Frank Gruber, your host. I'm also the co-CEO and co-founder of Established, as well as the managing partner over at Established Ventures. Today, we've got a great conversation that took place a few weeks ago over at our event that we host every third Thursday of the month, the Mic, over as part of the Established Network. And I'm going to be joined by two great guests, Jillian Friot from the Global Venture Network. She's the CEO, as well as Donna Harris, the CEO of Builders and Backers. I interviewed him, as I mentioned, over at the Mic, or the Monthly Innovation Circle, which we host every third Thursday, and you can sign up to be a part of it by going to est.us/the Mic 2026. We'll be hosting another one if it's the next third Thursday coming around. So there's always another train coming. So hopefully you can join it. Join us over there. And for those not familiar, the Established Network is a project we've been doing for a little while. It brings together investors and thought leaders and entrepreneurs, all of which are trying to move towards advancing their various missions. And so if you go over to established.network, you can learn more and sign up to be a part of that community. All right, now without further ado, let's jump into that interview with Jillian and Donna. All right, so welcome everybody. Give it a second here as we come off camera. Let's get started here. You know, we're in a new year. I always like to start with like kind of where we're at from an investment perspective, where we see companies, and you all work with a number of different companies and invest in companies. So, billions of dollars are being deployed, yet early stage founders are still hearing no more than ever. And I know it's part of the job as an investor, but is it broken right now? Are you thinking it's broken, or is there just, what's causing this, I guess, this, I feel like it's been like a couple of years of no's, unless you're an AI startup.
Yeah, I think that's pretty accurate. The unless you're an AI startup, and we'll have to try to match Jamila's energy. That was awesome. Great intro for all of us. I mean, I think the thing that comes to mind for me is the first check paradox, right? It's that how do you get a lead? I mean, that's probably the most common thing we get asked is we need help with a lead investor, right? And I think that a lot of that stems from kind of like the root of it going back to this herd mentality on, for investors that it's like, well, do I want to be the one to make a mistake, right? And putting themselves on the line that way may be even a bigger deal than missing out on something entirely. So I think that's part of the challenge. And Donna, I'm curious if you see that too.
Yeah, I mean, I think there's just a couple of layers of problems. We've got so much capital that's effectively locked up. So exits for the last however many years have just been slow going. So LPs that have money or had money aren't deploying it because they're waiting to get returns from the investments they made the last go around. And so that's part of the problem. And then you've got venture concentrating. Like if you're in AI and you're in Silicon Valley, it's a whole different world. And so we end up with the tale of two startups, right? Like if you're out in the valley, it's one set of rules. If you're not in the valley, you're not in AI, it's a different set of rules. And for the latter group, it is tough sledding. And, risk capital is kind of moved further upstream. So VC's taken a lot less of those early swings based on ideas and based on concepts and vision, and traction is becoming much, much more important. And at a local ecosystem level, that's impacting founders because you've got a lot of local investors going, well, wait a minute, I don't want to be that first check. So we've sort of shifted from risk taking to harvesting. Piling into the companies that are succeeding, but not necessarily being the ones to write the first check. And it's really, really problematic for founders that don't have those networks, that are in places outside of the valley, or are outside of what we consider to be consensus sectors like AI. And it definitely is creating a bit of a conundrum, because it also is a negative signal effect. If you're not raising capital and investors look and see the headlines, they wonder why all this money is being deployed, but you're not getting any. So it is a tough environment right now.
Yeah, we both made a bunch of great points, including, the idea of, you know, as humans, we're attracted to motion, right? Or forward motion and momentum. And if you aren't getting, part of that investment from these investors, it might look like you're not moving, right? And that's not necessarily a problem that they're creating. It's just maybe their location. So what are some things that founders can do that, you working with companies outside of the Valley? Like, what are you telling them as far as how do you get that first check and how do you get that first yes?
Yeah, I mean, we definitely encourage that. I think business gets done with people, right? Like this is such a trust related issue in a lot of ways. And how do we build that trust? And it does take time. And so I think there's the network effect. Of course, all of us are in this world of connecting people and creating opportunities and pathways for that. And we certainly encourage founders to lean into that. We actually partnered up with Flowly. I don't know if you guys have heard of them, but Flowly is an awesome way to see that, sort of like see it's sort of like a CRM in a way for anyone who's fundraising, but for founders, it's like, great, I can see it. Oh, I'm connected to Donna, and Donna knows, whoever at this VC, and they're potentially a really great fit for me. So like seeing those kind of connections and then getting the warm intros. We're in a time where the AI bots are cold calling is probably not really so much of an option anymore, or cold outreach, because everybody's getting more than ever on the cold outreach. So you need to lean into those warm intros and relationships and build that. We also like to phrase it as sort of like you have to be Yoda to an investor, right? Like you need to be coming alongside them as what do they need? Is this a match in the first place? And like that's okay to start with a coffee meeting and no pitch deck and just get to know them, build up towards the you've earned the pitch in a way.
Yeah,
Yeah,
that's great.
I agree with that. And there's
Drop
also,
that.
yeah,
Drop
I would
that.
say there's also some other dynamics too that if we think about like what do investors care about today that they didn't care about so much 3, 4, or 5 years ago, right? So there's much more emphasis on having a clear problem, who's the specific buyer, early proof that, used to be all about, we weren't so concerned about distribution. We were more concerned about product, and now distribution really is taking front and center. Real customers want to see pilots or letters of intent, paid users, really things that we weren't really asking founders to be providing at that really early pre-seed and seed levels, and being able to have a believable path to distribution, because it really is all about reducing risk. And then I know that, like, I know Jillian has mentioned this, and I just really want to double down on it, which is this concept of the borrowed trust, right? Warm introductions, credible advisors, early partners, respected ecosystem leaders vouching for you. When capital is harder to come by, being able to have people who are in your boat helping you paddle becomes important, and social capital becomes really important in this moment, which we can have a follow-on question around the challenges that presents for a good number of Americans.
Yeah, great points. And I think, a couple things like can't be that lone wolf, right? Doing your startup in your own little world anymore. You kind of need to make sure that you make those connections and build that out. And then the other thing you mentioned was like having more proof, right? Whether it be in traction. And that goes back to, I think, one of the first things you said, Donna, which was more or less, we haven't seen exits like we used to see exits. And I think that's part of it, right? So now we're trying to get like further down the chain because it could be a long road to an outcome, right? And I think that's,
Yeah, I mean, if you think about the way we used to raise, right, the popularity of a safe note
Mhm.
inherently means I've raised some money, and you're not actually going to be an owner in my company until I raise more money, right? Because it's only a promise of future equity based on a future fundraise. So inherent in that is this cycle that I'm going to raise and then I'm going to raise again. And therefore, I'm going to be able to make progress on my business necessary to raise again. And what we're finding is that this inability to raise capital and ability to get traction is creating problems at the conversion from pre-seed to seed to A. A is harder to come by. So you see a lot of companies that aren't actually able to raise those future rounds. So investors are starting to put two and two together and say, well, wait a minute, if my investment is based on you being able to raise a future round, I need to be able to feel that there's less risk, that you're going to be able to drive that scale well enough to become a VC backable company at the later stages, which is very hard for a lot of startups to do when you think about the pace and the level of growth that you have to achieve.
I think
Yeah. Are
that's
you
why we're
seeing?
seeing venture, like the popularity of venture studios. I mean, there's a number of reasons behind that too, right? But you know this well, I'm sure, Donna, from your experience in it too. The You can de-risk in earlier stages and in different ways than we have it, or we've seen traditionally with just one individual startup, right? And apply a methodology around that, and be able to be a bit more secure in what that future pathway looks like versus the big risk of everything is predicated on a future raise.
Yeah, and seed strapping, I'm sure everybody's familiar with that term, but we're definitely seeing an increase in being disinterested in being on the hamster wheel of round after round after round. But,
Right. Yeah.
what is the amount that I need to get raised in order to get to break even and sustainable growth? And then that buys me optionality in my business for maybe I raise more capital, but maybe I don't.
Maybe not. Yeah. And sort of rolling, like we're also seeing just rolling raises and not real rounds in that way. Um, and it's an interesting way to like sort of build this enthusiasm and like fan base along with you. And yeah, it's creative fundraising is sort of the theme, it seems like.
Yeah, and I think they've had to become more creative because it's just
Mhm.
a longer road and it's taking longer to get where they need to be. So I think back, a few years ago, that kind of approach might have been looked at as like or frowned upon, right? Like, oh, they must not be getting the traction they need or whatever. And now you're seeing it's become more prevalent for sure. I guess I wanted to touch on something you mentioned, less risk taking. Donna, I think mentioned it. You may have mentioned it as well, Jillian. Less risk taking. Is it less risk taking or is it different risk taking? Like, are they? I guess which is it? And I guess does it even matter?
Yeah. Yeah. Well, I mean, I would say it's different risk, right? I mean, investors are less willing to take that execution risk early. They don't want to fund long periods of uncertainty around whether you can ship a product or you can learn fast enough. They want proof upfront. They're still willing to take a big market and technology risk, but they're selectively choosing where they're willing to do that. AI infrastructure, defense, space, energy, if the path to relevance is clear. But risk has really shifted from can this work to will it scale? I think that's really, we're seeing a lot of that early checks being much more tied to whether a company looks fundable based on their ability to drive growth. And then I do think that in this today's world of AI, which everybody understands the buzzword, but maybe not the details behind the curtain, investors are struggling with how to take risk when they can't explain or understand something.
Mhm.
And so that's sort of bifurcating investors. You've got those that really understand it and are taking the big swings. Then you've got others that are saying, I'm going to actually go to a different space because I understand the patterns in that space. And I mentioned earlier that the default challenge that brings for founders is that is bringing back the idea of pattern matching, right? Repeat founders, familiar business models, consensus narratives, sort of herd mentality, who else is in the round. That, I think a lot of us that have been in ecosystem building for a long time have hoped we would be able to jettison some of that.
Yeah, no, it's definitely created that, and because of the comfort level around what they're investing and who the people are around them for
Yeah.
sure.
We're seeing
Um,
that too. I'd say from on our network of investors, it's concentrated bets on proven. Like, what does a proven team look like? What's proven business model look like? And then if you are taking that risk into a technology that maybe you're less comfortable or familiar with, but you know that the model is proven, then it's feels like a safer bet.
Yeah, this is a great spot to kind of interject with Donna, what you've been doing with builders and backers, because I feel like you're taking founders that are early on and getting them to the point where they're getting, a point where they could get investment, right? So can you talk a little bit more about that and how you're kind of approaching it?
Sure. I mean, I think our entire thesis is really based on this concept that there are entirely new ways that you can de-risk businesses than that you can generate evidence and proof. So the idea that we bring an idea to life by making big guesses is just no longer doesn't need to be true anymore. And so we've combined sort of methodologies learning, AI guidance, and human guidance so that we can help you move from stage gate to stage gate. So in theory, doing away with even the constructs of pre-seed, seed, Series A. Those are artificial labels we put on this fundraising thing. Instead, we can fund early experiments to prove your assumptions. We can fund inception stage funding to get you to first customers, right? So it can be very focused on milestones and deliverables. And we're idea agnostic. So we aren't forcing founders into the VC box. And we'll fund and help build everything from AI platforms and ocean wave energy tech companies to macaroon vending machines and hair extension companies, because all of it matters and it's all really, really fun and cool innovation. And 62% of Americans have entrepreneurial dreams. So we want to make that reality.
I love that. And you're at the opposite end of the spectrum of what we're talking about when it's saying herd mentality and AI only and everything else. So it's really
Yeah, and using data and milestones and evidence that somebody is driving their business forward as a peg to deploy capital and to help with our resources and our people and our social networks versus, who else invested in your round and how charismatic are you on stage at a pitch competition and how good are you at putting a pitch deck together.
Mhm. No, that makes sense. All right, let's pivot off that towards more founder related kind of questions here. So let's talk a little bit more about founders that are out there raising now, if they're listening or along here or watch this on a repeat. What should they stop doing immediately that you see constantly kind of repetitively happening out there?
I mean, I think we mentioned this one, but it's worth repeating if
We
we
both
call
took a big sigh.
yeah. The cold emailing, and it's funny, we were just at CES last week, and this came up a couple times too, and everyone's like, yeah, it's don't bother with the cold emailing. So warm intros, I definitely lean into that. Um, and and I think that the relationship building, and then just don't paint an unrealistic scenario. I think that's painting a very realistic scenario and leaning into, as we mentioned, the traction proof points and like what is that. I like to think of it as like, what's the thing that if someone were, I hear of an interesting startup, right? And then I run into Donna and I'm like, oh yeah, and I mention it to you in passing. It's like, what's that key traction point that I can easily say in a conversation, like you should have one of those or work towards one of those so that it's just really like they're investors walking away from your pitch, they've got that in mind and they're probably to go share that with the next person. So something, if you don't have it, then like, okay, it's a good goal to work towards.
Yeah, those are great.
Yeah, I'd add two other things well, all of that for sure. I'd add in days past, it was really a big emphasis on, really big market size. Well, how big is your TAM? And now it's really more about why you'll win and how you'll reach customers. So I'd say, stop focusing so much on the market size story and more on like, what's the winning strategy? What's your wedge? How do you win? And then I will say 95% of founders I talk to, they're trying to raise too much money, they're overcapitalizing too early, and they don't actually know what milestones the funding is going to help them achieve. So it's different from what are you spending the money on, right? People, tech, I want to buy this software, I need to do these campaigns. That's what you're spending it on versus and so it will help me achieve first customers, break even, test my market segments. Like investors want to focus on what are you raising and how's it going to de-risk the business? And you de-risk the business through hitting milestones. So
Yeah, those are great.
That's such a good one too, Donna. And I'll double down on that because I hear it so often. Like that's one of the most commonly heard questions I hear from investors after watching, after I see them watch a pitch, we'll ask, you know, okay, so what are you using? What does that result in when you say you're going to buy the software or hire a person, right? Like what's the outcome? So yeah.
Yeah, it makes sense. I think the other one I see too is just chasing the wrong investors, right? Like just not realizing that there's like so many different types of investors on specific verticals or at different stages, and just understand that landscape's super important.
yeah. And by the way, go a little deeper on your research. Just because I have the word builders in my company name does not mean I fund construction companies.
Oh yeah, I didn't even think about that. Do you get a lot? You must get a lot of
A
those.
lot.
Oh wow, that's interesting.
Do your research.
Wow. Yeah, do your research for sure. It goes back to just know who you're talking to, right? And so let's look ahead though, as we kind of look towards 2026 into 2027 too. I wanted to ask you guys, as you look ahead towards that, are you more optimistic or more cautious about early stage investing, and why?
Is it okay to say both, but
Yes,
for different
absolutely.
reasons? I feel like
Yes.
I'm hedging my bet, but like,
Yes,
yeah.
I'm selectively optimistic.
Mhm.
Yeah, I
Yeah.
mean, I'm optimistic about building, right?
Right.
Like it's never been cheaper, it's never been faster, it's never been easier to
Mhm.
test ideas, reach customers, generate proof.
Mhm.
Founders can validate demand with almost no capital, no teams, right? So the tools for distribution are there. So like I've never been more optimistic about building. But I'm cautious about fundraising. I think, and if you follow me at all on LinkedIn, I'm very concerned about the concentration in capital. I think that risk tolerance is lower when it should be increasing, and that first check continues to just be elusive for most people. So, I think in practice, 2026 is going to reward a certain subset of founders that are capital efficient, that can be proof first founders, but it's going to punish founders that just assume venture capital is going to behave the way that it always has.
Yeah.
Yeah.
Jillian, do you want
Yeah.
to add to that?
Yeah, I agree. I mean, I'd say I'm cautiously optimistic as well. I mean, I'm optimistic for, and I come from a bit of a sort of hard tech hardware background, and I'm super optimistic for my hardware founder friends out there because I think there's for a while it felt like hardware was, everyone says hardware is hard. Yes, it is capital intensive, yes. But there's these unique advantages actually that come with that. And it's historically been like, oh, well, that tech is there, but we really don't have the real world connection to it from the software side. And now we do. Like now AI and our software ability there is almost leapfrogged that. And so I think there's going to be in the next, whether it's 2026 to 2027 beyond, but I think we're going to see this interesting opportunity for those that have the combination of hardware and software or tech that's been there and now it can really be something that makes a life-changing impact. So I'm optimistic for like that sort of use case, those use cases of AI. And then from a fundraising perspective, yeah, I mean, I agree with Donna. I think I'm hopeful that there's less concentration and that things can open up a bit. And I'm optimistic from looking at some of the data on just new VCs that are emerging. And while it seems that, we do have capital that's locked up, I think we will also see this in the coming years. And again, I'm not sure what's going to happen in 2026, but I am optimistic for those that are out there trying to build, trying to do something different, trying to provide different opportunities for founders to get funded that in times like this where we're at the bottom, it can only go up from here, right? So I think we're going to see the shift and hopefully a new wave of what that can look like.
Yeah, I agree with that. And there's so many interesting people poking at how can we do this differently
Right.
and exploring not just alternatives to VC and more funds, but like how do we do revenue-based investing and what other alternatives can we be unlocking in our ecosystem to fund founders? So I think that is really exciting and would love to see that trend continue for sure.
Those are some great points. I mean, maybe you already just mentioned, but what is the most disruptive thing you're seeing like in that kind of realm? Because I'm curious if all of a sudden, venture is going to kind of start looking a certain way, and then there's going to be these other things that pop up that offer the opportunities needed to kind of like grow.
I mean, I think one of the things that I'm really encouraged by is the growing recognition that we as ecosystem builders, I've been in the ecosystem space, building space for way too long. And, I think the recognition that we all built something that we maybe don't love how central we put VC to it, over sort of over indexed on that. And how do we bring the pendulum back a little further away from that? And if we think about the average community, most entrepreneurs are not going to be VC aligned, but few ecosystems have built VC alternatives to fund their entrepreneurs at scale. So there's some interesting folks that are exploring community funds and leveraging sort of blended funds that meld VC and VC adjacent vehicles that I think, if you're an ecosystem builder on this call, it would be worth really exploring what some of those alternatives are and thinking about how could they be helpful to our community.
Yeah, we see that too. I'd say like that's what makes me optimistic for it is just I don't know that there's any one particular avenue that feels more disruptive than another, but that there is a variety and people who are, intelligent humans that are really trying to find something that's a little different and solve that problem of maybe traditional VC doesn't work in certain areas or every area of the world, and let's find a different way for founders to get funded. And yeah, sometimes it is more it's like a community approach. I'm also seeing, it's just interesting, but seeing some LPs or high net worth individuals just sort of like skip over and doing this like fundless kind of model. And yeah, I think there's just, it's like, what do we need to do to help solve the problems that need to be solved, right? Like, how do we get the money into the hands of the founders who are solving real problems?
Right. Explain that fundless solution you mentioned. What do you mean?
Yeah, I mean, mostly again, from high net worth individuals who have just heard, share this, where they are investing into funds, but they're also, in some cases, sort of working with someone who's bringing them a deal and saying, hey, I think this aligns with kind of what your interests are, and then just sort of bypassing
Got it.
putting it into a fund and just going directly into an investment into that founder, and sometimes bringing in others and saying, well, I sort of like syndicating, but with just high net worth individuals directly. And I don't know. I'm wondering if part of it is sort of the long, we're seeing maybe longer due diligence from VCs, and in some ways maybe it's family offices who are like, well, we can sort of just do this on our own rather than investing in a fund and having them do that management for us. We'll just make those investments.
Mhm.
We're seeing a lot of pooled activity as well, where some of the diligence is being outsourced, the outsourcing the GP role. So lots of innovation around that. And the thing that I keep hearing, and I just had this conversation with somebody yesterday, was we think VC is where all the big returns are going to come if you're a high net worth individual. But the reality is, if you look at DPI, right, how much distribution have you received versus what you put in? If you actually do a 3 to 5x revenue based investment vehicle, you're going to outperform most venture capital firms at this point, right? So, like, I think being smart about what kind of companies do we want to fund, what kind of companies are in our community, and what vehicles make the most sense. And it's a really interesting time when we think about venture capital itself being disrupted. Like, the job to be done is to fund startups. We just chose venture capital as one vehicle to do it. Doesn't mean we can't choose different vehicles as well. So we're very, very interested in, this whole world of innovation around how we not only help more people get started, but how do we get people funding that keeps more of the wealth in their hands?
Yeah. And I think we're going to trip a lot along the way. I think that we will find it's like, oh, this seems great. And maybe, and also depending on the startup, right? It may seem like revenue-based financing could be great for somebody and not for others, and so I think it's a bit of like, it's continuous iteration as it is in our world of startups, right? And we'll have to figure it out. So my hope is that everyone keeps a bit of an open mind too and says, well, just because it didn't work in this scenario doesn't mean it's a bad thing entirely, but let's, figure out where it does make sense and keep getting creative with these different ways to, as you said, Donna, to get the job done. Like we want to fund amazing founders.
Yeah, it's not every or the right fit for every company, right? Like revenue-based investing, great, but it doesn't
Yeah,
work
let's
for
have a whole toolbox and use the
right.
right tool for the right job. Not everything
Yeah.
needs a hammer.
Right, exactly. That's a great point. Yeah, so I guess the other thing I'm seeing too, and maybe you're seeing this too, is a lot more founders that have been in the venture kind of high growth startup kind of world jumping out and then starting to acquire more mainstream type businesses. So like
Mhm.
laundromats and parking lots and all these different things as a way to kind of generate revenue and obviously just churn out that and then invest more of that into venture. So I think seeing that trend with a bunch of folks that I'm connected with
Yeah.
more than I ever have. Like that was not something I was hearing like 10 years ago.
Yeah, yeah. And if you think about what that looks like, if you have a vertical of interest or a particular business model of interest, you see that that high net worth individual has a network, they have capital. So not only are they getting things started, but they can quickly pull together SPVs to fund companies that are in that space and being able to get super granular about it. Like we have a company that we help launch through Builders and Backers that he has a very niche solution for a segment of attorneys called Leximed.ai. And his investors are primarily other disability attorneys that recognize that, oh my gosh, I wish I'd built this. I need it immediately. So they're becoming customers and they're investors. And we see that model happening over and over again in different markets.
Right. That's interesting. All right. So we talked a lot about a number of different things here. I wanted to circle back a little bit about who's you know who's getting left out right now, because I feel like there's still, like, we've got this AI group over there that's over in Silicon Valley getting funded on ideas and not having a deck, just like, and then you've got this other group that's like, we need core revenue and traction, and who's missing in that group, and then obviously across the country as well, like you're seeing, there has been you can start anywhere now, right? But still, you still need to have that connective ability to kind of raise the funds if you're going that route. So just want to see what you're seeing and just better understand that landscape from where you're at.
I mean, there's the obvious, I guess, we do still see just by the numbers, right, women and minority founders who are still left out. So that's, I mean, somewhat of an obvious one in that direction if we're speaking kind of broadly, right? And and then I actually think, in a way, I think we're seeing a shift out of, and Donna kind of mentioned this in the beginning too, like product focus and SaaS in some ways. I mean, if it's AI related, sure. If it's not, we're not really seeing anything going towards that. But I actually am seeing more interest in, and maybe as you mentioned, Frank, like sometimes the like boring businesses, and whether it's buying them or it's starting something new that's innovating on, in an older industry that is ripe for that. We're seeing more of that, which maybe is because it feels safer and at this time of uncertainty. But yeah, I mean, I think our communities, and kind of going back to what we were first talking about, just emerging markets and those that are in that spot of having a hard time finding lead, and then having a hard time with that time scale of, how do I keep this from getting locked, and not really having any momentum there, that those that are in markets that are not your typical San Francisco or Boston can have a harder time with that. And of course, all of us work towards trying to solve for that. But it's definitely still a challenge, and still what leads to the portion of founders who are left out.
Yeah. Yeah. I mean, Donna, did you want to add anything?
Um, yeah, I mean, look, I raised money for my first business over 2 decades ago. And as a young female without insider networks, not living in a tech hub, it was extraordinarily difficult. I am in the midst of raising some money for builders and backers, and I marvel at how little has changed in 25 years. And I don't say that lightly. And I really recognize that if I, as a six-time founder, two-time venture capitalist, and top investor, struggle, holy cow, what does that look like for an everyday innovator in America who doesn't have a track record and doesn't understand how this works? And I just really want to double down on what I said earlier, that it is a tale of a haves and have-nots. I'm sure that if I was in a life position to pick up my family and move to Silicon Valley, it would be a different story. But I'm not. And unfortunately, or fortunately, that describes most of American ideators. So if we really want to get the benefit of American ingenuity and be a country of builders, we can't make that the way you get funded. And so, yes, we're leaving out women, we're leaving out underestimated founders, but we're leaving out the majority of Americans with ideas. That's just the reality.
Yeah. And regionally too, like certain areas, just it's hard. There's
It's
just not
just
enough.
hard. It's hard, right? I spoke to somebody from, I won't name the state, but
Mhm.
she's like, in another state, this would be, 30 or 40 conversations. In our state, it's 300 conversations in order to raise the same amount of money. Like, it's just monumentally harder. And that is also a statement about the fact that, there's enough wealth in every state in the union to fund the level of entrepreneurship that would be mind-bogglingly game-changing for our country. But the majority of that wealth is not engaging in entrepreneurship either. So, like, it is a story of opportunity cost at this point.
Yeah. And I
Yeah,
think part of what why I wanted to bring that up is more or less kind of leading us towards, like, what can we do as investors, and what can others listening do, as whether they're investors or not, to help, unlock that opportunity.
Yeah. I mean, we run a monthly deal flow call to share, founders who are not in the major cities. And it started, for anyone who's listening who may have been a part of it, but it's called Venture Next, and we run it now as part of the Global Venture Network. And it's awesome because it started as a Midwest. It was like, hey, let's share deals across the Midwest for founders who are having a hard time raising money and feel like they have to leave, the Midwest in order to do that. And they shouldn't have to. Like, we should be able to solve this problem here. And then it's kind of expanded to, and we've looked at it as, how do we help founders anywhere that are not in the major tech hubs be able to do that and share deals, and ideally lead to, syndicates, or just that awareness and somebody being able to share that. And so, I mean, opportunities like that, this network effect that, can be, hey, let's band together across, similar types of regions, or like recognizing each other. I'm here in Memphis, Tennessee, and to say, let's look towards, New Orleans, or towards, any other ecosystems around Birmingham and other ecosystems around us, that we can all work together on this. And it doesn't just have to be here, but that can happen sort of anywhere, is this network effect. So I think that some of the ways we can do it is just looking at that, and how do we share this with each other and lean on that trust relationship. Um, but yeah, it is definitely a big challenge.
Yeah, definitely. All right. Anything else to add? Because I can keep moving here. We've got a lightning round coming up here.
I mean, I just would add, I hate to sound like a broken record, but I do think the more that we can decenter VC as the default,
Mhm.
it's not anti-VC, but it's not the default. It shouldn't be the default. This is not it's an expensive asset class for a tiny slice of startups. So we should decenter in our ecosystems. Whatever we can do to dethrone it as the default way we fund startups would be amazing. And then I think, you know, reframing, what does investable and successful mean at the ecosystem level? Like, successful being revenue generating, profitable, like being able to tell those stories, not as like the consolation prize story, but like, let's center those success stories. I think then I do think there's a layer of influence for policy and civic decision makers that, one of the biggest disappointments over the last few years is, like, we had all this money coming from Treasury for SSBCI funding, but it went right to VC structured vehicles versus thinking about how could we use that in a way to create a full stack approach to funding entrepreneurship. So, and that's, simply because of the centrality that VC has played in the conversation around entrepreneurship. And so we've got some work to do to, bring that pendulum back to center, where we have VC plus other alternatives. And I think ecosystem leaders and policymakers can play a role in helping make that happen.
So anybody listening, that's a call to action to be creative and think about how other ways that you can, fund startups, whether, doesn't VC is not the go-to. It has been propped up, right? There's television shows about it now. It was not that way 20
Shark
years
Tank of America, Tankification of America.
Right. I mean, that's really it's educated people in a way that's like made VC the standard. And again, and I say that as somebody that's been investing in venture, via venture. So I think but at the same time, it's not right for every single person. So
Yeah.
or every
I
kind
had
of
a business school professor say to me that he was meeting with his students, and they were in an entrepreneurship class, and he was asking them, they had a variety of businesses, restaurants, product companies, you name it. And he was asking them how they would fund their business. And 100% of them said they would raise venture capital.
wow.
Wow. Wow.
So
Well,
whoever led that marketing effort did a great job.
So whoever's in charge of marketing for venture capital, you win the prize.
Yeah,
oh my
exactly.
gosh. I love I love hearing often our members will, are usually tasked with being somebody else, giving one of those talks, right? And I love to hear it when they're like, I'm going to tell you why to raise venture
Exactly.
capital, right? And like, let's go
Probably
through.
your restaurant is not going to be venture capital right now.
Yeah.
And even maybe your SaaS startup shouldn't be either. Like, it's like to
Exactly.
see the whole, like, hey, let's play this out and run through the scenario of what does this look like when you start getting diluted, and it's just run this out for about 10 years and see how this goes. It's like, maybe this isn't really the right move. And what happens when you take that capital, and just seeing that, play out. But and I think it's a good point to even stress on, like, accelerators or venture studios, that is also an alternative. It doesn't mean don't hop straight to venture capital, but like, hey, go through some of these. Well, that we've had a boom of them, and then that means there is a variety and quality. There are still a lot of really rock star, excellent programs and opportunities out there, builders and backers included in this, to, experience, get some of that hands-on support and potentially some funding in through that process as well. And then, it's not jumping the gun on VC.
Yeah. Yeah. No, I love it. I love it.
Yeah, I've definitely seen a rise in venture studios for sure. I mean, across the country. He was part of this venture group, and there's like last year, I think there were like 30 or 40 all raising their funds at the same time with me. And I was like, wow, that's quite I mean, that was not the case like 5 years ago, 10 years ago. And it's become more prevalent. So I think there's a reason for that, right? And I think part of that is that you're seeing more companies come out of it in a better position, less risk and all that. So I think that's, I think it's part of the reason, right? So I think probably see more. So I guess I guess we go back to that question of companies being investable, if they want to be. Um, I guess from your perspective, Donna, first, like you're seeing companies like early on, idea, right? Like idea stage. Is that where you're mostly intercepting people?
Oh, yes, but we also see them at later stages as well.
Okay.
Yeah.
And I guess, what are you seeing the most of, and what do you get like, are there any like red flags you're seeing as you're like, as you see these folks that are like, consistently killing an opportunity for you to get involved?
Yeah, I mean, you definitely see some of the same mistakes over and over again. You're like, don't do this. Um, I mean, first of all, the pitch just not being clear and in plain English. It just feels like people think they've got to throw in all the jargon and VC soup into the deck. And
Mhm.
if you can't quickly understand what a company is going to do, you're getting sourced out of the stack, right? I mean, VCs are going to do two passes through your deck, maybe. First pass is a quick scan through your slides. You're going to be lucky if they spend 30 or 45 seconds scanning your slides to decide if they want to spend 2 to 3 minutes doing a bit of a readish on your slides. Like that's the reality because you get so many
Yeah.
pitches coming in. So it's got to be understandable. And then if and when I'm talking to the founder, I'm always fascinated when founders are not coachable and they get defensive. I think they're uncomfortable disagreeing with an investor. And sometimes investors are trying to see how you think about your business. So they're purposely being a bit like not inflammatory, but like they want to see how you're thinking about the company and how you process feedback and if you can admit what is known and unknown. And so I'm always amazed at like everything is perfect and beautiful and I don't have any problems with my business. And then I get defensive when you find a hole. It should be a back and forth conversation. I want to know how you think about your business.
Yeah.
That is number one. I think you're reading my mind. Defensiveness is like the number one thing that's like, oh, this is not going to go well.
Yeah, uncoachable. That's why, even though I don't think uncoachable is actually a word, but that is my
It
number
is. Yeah.
one as
Yeah.
well.
Yeah.
Yeah.
Uncoachable is definitely a word in my book. So definitely on that same page. All right, let's go to the questions. There's some questions in the chat. I'm going to try to summarize this one. It's a long one. Um, so there's a company called Mind, and they've got a proven track record in long-term care communities. They're looking, let's see, do you have any advice for gift-giving orgs who will align with serving underserved communities? Similar to like Cohen Foundation, who is partnered with Elderverse and CTA Foundation. It's a very specific one. I don't know if either of you have a response to that one, but it was the first question that I saw.
Possibly, but I mean, I worked for Dassault Systems for many years, and we do have a foundation through Dassault that sometimes it's always worth. I mean, I always encourage people to apply because you never know. I will send the link here.
Okay, great. That's a quick answer on that one. And then also, other than traditional venture or RBI, revenue-based investing, have there been other creative capital programs you've seen that have could be adopted by other communities?
Yeah, we've seen several. National Coalition for Community Capital, NC3, has community funds that will do a blend of real estate and startup investing, and it is for non-accredited community members to fund cool companies in their cities. It's a great way to fund everything from restaurants and bars and breweries and coffee shops to tech startups. And I can pop the link in while we're chatting, so everyone's got that. Um, but like I think there's a lot of folks like Chris who runs that organization that are thinking about community-based funds and ways that that could be activated.
I think it's a really interesting one because of the fact that, like I said, mentioned earlier, like you're seeing more people get back into like that. I don't call it mom and shop, but like brick and mortar kind of businesses. And, you know, there are people starting like from scratch, even, you know, the breweries and the coffee shops and whatnot. So that's a really good one. And granted, they're not AI companies, but they still need investment at some point to grow.
Yeah, they've really found an interesting layer to the SEC regulations that allow you to use a real estate focused fund to do startup investing. So you will find a community fund that has a restaurant and a coffee shop and AI startups that are being invested in by that community fund. It's really an interesting model. And really the distinction is that just a certain amount of capital has to go to real estate related investments, which actually has a pretty broad lens. So it's not just like apartment buildings, but it's a really good fit for place-based investing when you want to invest in a whole array of entrepreneurial ventures.
Yeah, that's really interesting. I'd not seen that one before, so I appreciate you bringing that. And I think we're almost out of time. So last question, I guess, is there one message you want, you know, both investors and founders to leave today with, and, you know, what would that be?
Mm.
Hmm.
I mean, I'll start, and I don't know. I really feel like even though the fundraising environment is hard, the fundamentals of building something that people want have never been sort of stronger. If you focus on customers first, think of capital as a tool, not the scoreboard for whether you're succeeding. Um, I think that this can actually be a really exciting moment with that reframe.
Definitely. I love the
Yeah,
optimism.
I agree. I think of it as like some of the best companies have been built in really challenging markets, and constraints lead to creativity, right? Like it's something we've said even in great markets. And I think this is the time when we lean on that optimism of constraints are going to lead to creativity, and investors, whether they're investing in a fund or investing into a startup, are looking for people who can navigate that uncertainty. So I think the last few years have helped us all learn that skill of navigating the uncertainty, and showing that you're a founder who can do that. I think is going to go a really long way when you're fundraising.
Yeah, and I didn't touch on that, but we have been in a little bit of a rocky road since I'd say 2020. So like things have been kind of up and down, and I think evolved just to come to accustomed with that. So I think, you know, that is not something I touched on, but yeah, it's been about 6 years of up and down in different directions with the world. So great points, both of you, and thank you for joining. I think my last point would be like similar to you all. It's like we need to, you know, innovation isn't going away, right? Like we still need to kind of keep moving forward. And so if you are building something that's real, this is an actual opportunity for you, and obviously capital if will find you, and you know always finds clarity in that. So I think just keep going, and obviously leveraging your network and things like this kind of established network and others that have been mentioned to kind of keep moving forward. So thank you all so much for being here. I know Jamila's ready to jump back in here. So Donna and Jillian, thanks so much.
Thanks.
Thank you.
All right. Thank you so much, Jillian and Donna. That was great stuff. Really appreciate you sharing your insights and being a part of this community that we're continuing to cultivate. So thanks for being part of the podcast. We appreciate you being here. All right. For those listeners that remember, you know, we always try to get you going, get you started. But if you're new to here, you know, appreciate you being here. And there's no better time than today to start your entrepreneurial journey. You can join our community. We're going to try to help you with the various resources and network development that we offer through our various offerings at Established Network. Until next time, I'm Frank Gruber signing off, and thank you so much for being here.
Thank you for listening to the Established Podcast. Be sure to subscribe, leave us a review in the App Store, and share the show with friends, colleagues, and on social. Together, we can help more innovators become established. We'll be back with another conversation soon.